Friday, December 20th, 2024, Monaco 64, home of alternative economics and contrarian views. Well, today we're going to talk about the future U.S. Treasury Secretary or Treasury Secretary designate, Scott Bessent. He said something recently in an interview that's quite worrying, or in a story from Bloomberg, and it's about rollover risk. And that's what I'm going to try to explain here today. I'm going to recommend also an old movie called Rollover, actually, from 1981. You might have some time over Christmas to watch it. I've watched it again. I watched it about a year ago. Someone told me about it. It's on Amazon Prime if you've got that, or you might find it elsewhere. It was a flop of a movie, apparently, and I didn't even remember it, or I didn't even hear of it at the time. But I think it's really pertinent to what's going on today. And before we go deeper into the rollover, just wanted to share this headline here that I saw that makes it also very significant, the debt, right? And the debt is the most important part of this whole monetary, financial system, economic system that we have, of course. And we've seen overnight this headline here. This is from the FT. U.S. government shutdown looms after House rejects Donald Trump-backed funding bill. Congress faces Friday night deadline after president-elect helped kill initial draft legislation. U.S. Congress has to find a deal on Friday, today, to keep the government open after the House of Representatives voted down the latest version of a funding bill despite support from Donald Trump. So there you go. This always seems to come up now every 2 years or so. And I remember well that back in 2011, because of the debt ceiling crisis, S&P, Standard & Poor's downgraded U.S. debt. I'm not saying they're going to do that, but it's a possibility. So before we go further, just wanted to wish everyone Merry Christmas or Happy Holidays. And how's our schedule going to be over this festive season? Well, I won't be doing the live stream this coming Sunday. I will be posting a couple of interesting interviews, I think, in the next few days. Might not be as busy Christmas week. But probably be back to normal on the 30th of December. Maybe I'll post something next week as well. And yes, I really wish all of you, yeah, health, wealth, and happiness, because that's what it's about. I know this channel focuses on money, the economy, but money, of course, is just a tool that we have to store and transfer the wealth that we try to create in this world. And of course, government always gets in the way. And that's another part of this channel is that we try to espouse views of very limited government, of self-reliance and free markets. That's the way I see it. And the other thing that we need to keep in our minds and hearts is that we need to be nice to everyone, just like we like people to be nice to us. So the golden rule. So I'll stop here with that message now, and let's get back to business. Let's get back to Mr. I think it's Bessent. Some people call him Bessent or Bessent. I'm not too sure. Anyway, it's a French Huguenot name. The French Huguenots, of course, had to escape religious persecution in the 17th century in France. And a lot of them went to the US or the New World at the time. A lot of them actually came to England as well. And a lot of them went to like South Africa. But anyway, that's a bit of history for you. I read this article a few days ago. As you can see, it came out 16th of December here on Bloomberg UK. It says debt risks that lured Bessent to U.S. Treasury now loom large. And you can see this little number here, $1.8 trillion dollars. Yeah, that's the deficit for the 2023-24 fiscal year. And we saw the other day that the first 2 months of the fiscal year, which is starts in October, so October, November, the first 2 months, there's a record deficit of 620 billion or so, which if you extrapolate, it's like over 3 trillion a year. But this here already is over 6% of GDP. And usually that's run during a recession, not when the economy is supposedly doing well. But let's just go a little further into this article. It says Trump's choice to run U.S. government finance was part of the Soros team that crashed the pound. His new reality is more complex than exchange rate wager. Yeah, this pound crashing that happened in 1992, I remember really well. I had just arrived in London to work for Cantor Fitzgerald back in September of 1992. I'd been poached by a friend of mine who worked there from my job in Switzerland. And 2 or 3 weeks after I arrived and started working, the pound crashed. We didn't know at the time that Soros was involved, but it was quite an amazing market event. Anyway, Scott Bessent built a career on understanding when a government's economic policy narrative was fundamentally out of whack with reality. If he's confirmed as president-elect Donald Trump's Treasury Secretary next year, his new job will be to ensure the US government doesn't face on his watch the kind of make or break moment that he saw other nations experience during his decades long career in finance. The challenge is real. Bessent will be inheriting a trajectory for federal borrowing that's far worse than any of his modern day predecessors. So, yeah, precarious situation. And I'm going to skip to a part of this article that I did a screenshot of. And this is what I want to talk about today. The rollover risk. So it says here, one risk Bessent and other Republicans have focused on with regard to federal borrowing is rollover risk, or the danger that a sudden drop in investor appetite at Treasury auctions leaves the government unable to raise cash to pay for rapidly maturing debt. So, rollover. Yes. So the US government or Treasury, unless it runs a surplus, the only way it can pay maturing debt is through issuing more debt. So let's say Saudi Arabia has 10 billion invested in a certain bond that matures next year, and and then the Treasury will issue a new bond, and Saudi Arabia would take that 10 billion and buy the new bond that's rolling over. Or Saudi Arabia could take the 10 billion, sell it, and buy gold, get out, right? That's the rollover risk, is that investors become lose confidence, faith and confidence in the U.S. Treasury. And I think the story that's come out overnight about the government shutdown because of the difficulty of getting, keeping the government open, that's something that could help not just foreign investors, but domestic investors lose confidence in the Treasury, in the Congress, in the whole system, right? The other thing that could make investors lose confidence is the stability of the bond market. And what do I mean by that? Well, let's start with bond prices, because that makes more sense. to look at the bond price. So here I've got a 5-year Treasury note future, and it's going back all the way to the late 80s. So I pretty much started in the markets here. You can see the price was a lot lower, but we had, of course, ever since the early 80s, actually, a bull market in bond prices. But ever since 2022, we've seen a collapse in bond prices. And that's why bond yields or note yields or interest rates have gone higher. And I think, of course, this long-term bull market is over. But let's just look at this chart. So we had a huge drop in 2022 up until October 2023, things stabilized. Now they're kind of consolidating, but knowing technical analysis, aside from the fundamentals, I can tell you this technical formation is not bullish. Yeah, of course, we could rebound, but I think it's highly unlikely. So what is likely to happen here is that this first leg here will be mirrored over here somewhere, sometime. Difficult to say. So if prices continue to drop, what's going to happen to Treasury yields? They're going to go higher. That's despite the fact that the Fed might still cut the very short-term rates, or they might not. We've seen recently that they went from forecasting 4 cuts to 2 cuts at the recent meeting. And they might even in the next meeting say, we're not going to cut anymore. So with the debt growing so quickly, like a trillion every 100 days, this becomes a problem because it means the Treasury has to find more and more revenue to pay the interest, and then the interest keeps going up. They have to issue even more debt, and we get the rollover problem. We get the confidence problem, right? We could see investors go on strike, not just foreign investors, but domestic investors. Foreign investors, of course, they especially the sovereign non-NATO countries, they're paring down the amount of treasuries they have. They're trying to move away from the dollar, right? So this is the same thing with the 10-year treasury note. Same kind of setup. Doesn't look good, does it? And I'll give you the 30-year. So all across the curve, things don't look good. So what else have we got here? Well, we've got gold because some of you might be concerned about gold and silver, what we've seen since November. But just like the trend in bonds has been broken from an upward cycle or upward bull market, as you can see here for the 10-year note. I think the trend for gold and silver is still up. So if anything, we're breaking out on the upside. So rollover risk. So this is a clip from that movie in 1981. It was made. It's Chris Christopherson and Jane Fonda, the main characters, and there's like a kind of two stories in it. There's their personal story, and then there's the main story. The main story is that there's something fishy going on, and the Saudis are actually slowly getting rid of their treasuries. And guess what? Buying gold. And it reminds me of what's going on, what's been going on in the last, since 2022, especially where non-Western countries have been accumulating gold at record levels. And we know this, of course, on this channel because we focus on gold. We focus on sound money. We focus on the fragility of this whole system that we have. But I would say 99% of the people out there have no idea that the world is accumulating so much gold. Everyone's focused, of course, on Bitcoin, right? So I'm going to play this clip here for you, and you can listen to this, and then I'll try to explain to you what it means.
You have 21214 listed as a foreign exchange account. But you don't buy other currency with those dollars, you buy gold. But you have to do it slowly because if anybody finds out what's going on, the dollar will drop and all the Saudi investments over here won't be worth shit.
Then they'll go to selling gold. That won't work either. Then they'll have to go to capital controls, freeze foreign assets, stop any money from going in or out, and that will be the end of all the markets. That'll really be the finish. Then you'll see a worldwide depression that will make the 1930s look like a kindergarten. In 2 months, you'll have bread lines in Detroit, riots in Pittsburgh. In 6 months, you'll see grass right over Rodeo Drive.
Stock market's up 75 points. The dollar's appreciated 10% and moving down. They even yanked the euro-dollar deposits that weren't due. This New York is practically down the tubes and gold just went over 2,000.
By tonight, that'll be cheap.
So there you go. That's when we had the crisis there in the movie. And it wasn't just the Saudis, the whole investing world was not renewing its loans to the U.S. government or any other dollar loans. They're taking their money and leaving and buying gold, and the dollar crashed against all the other major currencies. But you will see if you watch the movie that at the end, it's not just the dollar that crashes, but the whole it spreads worldwide. So, and again, it might start with the pound. We're seeing the same kind of problem here in the UK. We're seeing yields go higher. We're in a recession, so it could start here, but it could also start in the US. And I want to talk about Scott Bessent. He did an interview with one of his old colleagues, and I'm going to put a link to it up in the description because they're on YouTube just before the election, before he was even appointed by President-elect Trump. And you should also check one of my videos I did recently about Scott Bessent. And I spoke about the fact that he thinks we are on the cusp of Bretton Woods-like realignments. And what that means is that he thinks the whole world's monetary system needs a realignment. And that's because the current system, you would only need that if the current system collapsed. And I just wanted you to listen to a clip from his interview here with Macro Maven. And I took the clip. Listen to what he says here.
I think we are in a long-term bull market in gold. I think we're seeing reserve accumulation by central banks. I follow it closely. It's my biggest position.
So there you go. I follow it closely. It's my biggest position. Um, so is he and the whole Treasury apparatus that's coming in on January 20th, are they concerned about a rollover risk? I definitely think they are. And how would that translate into? Well, that could be a failed U.S. Treasury auction. Yes, some of you might say they will not allow a Treasury auction to fail. And how could they do that? Well, the Exchange Stabilization Fund, which was set up by FDR back in 1934 with the profits of the gold confiscation, they could come in and buy their own paper because that's what it would be, the Treasury buying its own paper to save the day. But I think the market would smell that, and there would be panic, and eventually I don't think even the Exchange Stabilization Fund could save the day if investors run for the door, because that's what not rolling over your investments. That's basically what it is. Let's say you have a 3-month deposit, money market fund or whatever, or savings account. It comes due and you tell the bank or the broker, I want to put it on again for 3 months. Or you can tell them, well, actually send the money to my bank account. And then you go out and you buy gold. That's what the rollover risk is. But you have to think of in a global scenario, right? And what that would mean, that would lead to even higher uh, bond yields and interest rates. And why is that? Well, because there wouldn't be anyone, well, yeah, in order to attract people to roll over, you have to let yields rise, right? The prices go down and then they'll be attracted. And the only problem with that is that it would create a lot of instability in the stock market, in derivatives that I haven't spoken about, which is huge. The exposure is unknown because a lot of derivatives are over the counter. Some people argue that there's at least 1 quadrillion, which is basically a trillion in derivatives. And derivatives, of course, are just side bets on interest rates, government bonds, corporate bonds, foreign exchange. Those are the biggest sectors that are covered by derivatives. So if you start seeing yields rise, bond prices fall, it could be really disastrous. And there's another scene in the movie where the head trader at it's a Burroughs National Bank, he says on the day that everything's kicking off, he says, sell everything you can and get as much bullion as you can. So it didn't say Bitcoin, of course, because back in 1981, there's no Bitcoin. Will Bitcoin survive this? I don't know, but I don't want to risk. I wouldn't risk what I have to find out. I mean, you might want to keep a little bit of Bitcoin, but I'm not too sure how that would work with Bitcoin. And I think what we are approaching here, let me go back here. John Exter, right? I've spoken about this. This is what could happen. And am I saying this is going to happen next year with the new Treasury Secretary, this rollover scenario? No, but I think it's a high probability, and I've never really heard prospective Treasury secretaries or Treasury departments talk about rollover risk. I mean, this is something the U.S. has never had to worry about because the U.S. Treasury market is basically supposed to be risk-free, and it's where the world, up until recently, placed its reserves. But as we've seen lately, more and more are placing their reserves in gold. So John Exter was an American economist, member of the Board of Governors of the United States Federal Reserve System, and founder of the Central Bank of Sri Lanka. He's also known for creating Exter's pyramid. You see, he died in '06. I've been aware of this even before he died. One of my colleagues at work and I used to look at John Exter. I mean, that's the kind of stuff you look at when you're into gold. So he became a gold bug. I know he worked for the Fed, but he was a gold bug. He started buying gold in the 60s. There were ways to, of course, circumvent the Executive Order 6102 by FDR. You could buy collectible coins. Sovereigns were considered collectibles. So he was buying gold throughout that period, and he could see it coming. So Exter's pyramid, what is that? So let's go through here. Exter is known for creating Exter's pyramid, also known as Exter's golden pyramid and Exter's inverted pyramid for visualizing the organization of asset classes in terms of risk and size. In Exter's scheme, gold forms the small base of most reliable value. There you go, most reliable value. And asset classes on progressively higher levels are more risky. The larger size of asset classes at higher levels is representative of the higher total worldwide notional value of those assets. Well, that's the leverage in the system, and that's why interest rates are so important. While Exter's original pyramid placed third world debt at the top, today's derivatives, there you go. It says derivatives is a contract that derives its value from the performance of an underlying entity. The underlying entity can be an asset index, currency, interest rate. Is often simply called the underlying derivatives, can be used for a number of purposes, including insurance against price move. The problem with derivatives, and that's something a lot of people don't know, is that it's off balance sheet. So a lot of people don't know what's going on, and it's also highly leveraged. So let's have a quick look here. So this is the derivatives, unfunded government liabilities, non-monetary commodities, private business, real estate, corporate and municipal bonds, securitized debt, listed stocks, government bond, treasury bills, paper money, gold. But we've seen that with paper money, there's very little paper money out there. A lot of money that people think they have it in their bank accounts on deposit. And I've made a video before that banks hold a fraction, a small fraction of the money that they suppose hold for you. So paper money is not, yeah, it's safe, but outside the system, I would say. Where would cryptocurrencies be? I mean, I think they would be above government bonds and treasury bills. Some people, the Bitcoin crowd would argue that it would be here, but I'm not too sure. And I would add silver to this as well. So, yeah, you might be watching me the first time. You might be thinking, should I get some gold? Well, I've been on this channel doing this for 9 years, and I've told people that I think it's a good idea and it's up to them, and that you need to do your homework, find a reputable dealer. But I've also got some affiliates, dealers that I trust and can vouch for. So in the US, as you can see here, Miles Franklin is my affiliate in North America. I am in the UK, of course, but and they have various specials every week, or maybe you want to get something else. So if you want to find out more about Miles Franklin, yeah, there's some details below in the description of this video. And here in the UK, I'm affiliated with Gold Investments. I've been dealing with Gold Investments personally since 2002. They've been in business since 1981. So again, all the details are below in the description. Yeah, you might want to put some of your assets outside the system. It's always good insurance. That's what gold and silver are, insurance. They're not like speculative assets. Yes, gold futures and ETFs, in my opinion, they're speculative, but not real gold and silver or real money. Let's quickly look at where the markets are this morning then. It's going to get a lot quieter, of course, over the next week and up until the end of the year. It's 10 to 8 a.m. London time. We are a bit early today, Rudy and I. We've got spot gold at 26.05. It's up $10. Silver is having a tough time, I know, but I'm I'm not getting rid of my silver. I'm probably gonna get some more over before the end of the year, actually. But we are trading at 29 exactly. We're down about 6 cents. The Dow futures down 65. The Nasdaq 100 futures down 105. S&P is down 14. So stock market still under pressure. The currencies are pretty steady. Crude oil is down 2/3%. WTI is at trading around 69. What about the bond market this morning? Well, the 10-year Treasury yield is down 2 basis points at 4.55, but we are near recent highs, and I'm going to show you the chart here. I can show you the chart. I'm going to bring it up for you. You notice today I'm doing my video differently here. I'm doing it on Zoom so we can share things. So I'll just give you an idea of how fragile I think the bond market is. So this is the 10-year yield here, as you can see. This is the highest level we've had. Let's see, since yeah, May, June, earlier this year. And you can see the 475. That will be a key level. And then you can see this is more long term. This is the level we reached in October 2023, just over 5%. This is where things could get very interesting if we get up towards 5%. We might have a correction in the short term, i.e., bonds could rally and the yields could drop, but I think the trend isn't very good. So keep an eye on the bond market. As you can see, you can find it on investing.com under bonds. So there you go. With that, I'm going to wish you all Merry Christmas or Happy Holidays, whatever you celebrate, and also a Happy New Year, even though we'll probably talk before. So, with that as well, I'm going to wish you all a very good day. Take care. Bye.